2025 has been a roller coaster of a time to be investing in the US stock market. We've had massive fluctuations in both individual stocks and index funds, like the Nasdaq 100 being down close to 10% still year to date, which I believe in cases of some stocks that I have picked today present a great opportunity to outperform. I'll be going through these companies, why I could be seeing them do well from here, and their fair values and possible expected returns using my valuation tool on Stockerluck. If you get some of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. First stock we're going to be touching upon today is, of course, one that's in my portfolio, my £56,000 portfolio on Trading 212, and that is, of course, Amazon. Now, Amazon is my largest position in my portfolio, and therefore I have quite a lot of conviction in this stock. But one of the things I would like to say about this stock for outperforming and doing better in the future is because of how much it's down more recently. Currently it's down about 19% in the past 3 months. And I've got around about a 13,000% position on this portfolio that's not too far away from the current share price and cost basis that we're seeing. So I want to talk about why I believe that this cost basis can go on to do better than maybe, say, the S&P 500 in the next 5 or so years. This company's revenue growth is still amazing, and there's so many good reasons to enjoy and look at this company with a lot of conviction. We can see that there's a hell of a lot of consistency with their revenue growth despite it being a capital intensive company, and this is a company that is still growing its revenues over 11% in the past 3 years and still above 10%. So there is still a lot of organic growth with this business, and even though it's slowed down, it's still very relevant today. Now, this company is amazing for lots of reasons, due to its scale, its continued revenue growth, growing profitability, and diversified business segments. But when I choose to invest in a business, I choose to write down their thesis and refer to that rather than the share price. Because if we look at the share price, it's obviously not doing so well of late. We could be starting to think this stock is underperforming for some reason if we're not looking at the fundamentals of the business. But the fundamentals of the business as they stand are this is an incredible business that is growing very rapidly still, especially in the profitability category, which is somewhere Amazon hasn't always excelled. Right now, they're the number one in e-commerce provider in the US and Europe, number one in cloud service provider in the form of AWS. There is dominant market position and still growing around about 19%. The number 2 in streaming service in the form of Amazon Prime, just below Netflix. And number 3 in advertisement revenue at a 19% growth rate. And all of that is leading to higher margin segments, leading to greater profitability among this business. And all of it mainly means that this company is going to continue to grow its operating cash flow and free cash flow considerably into the future. Now, whether they continue to devote a lot of that to capital expenditure and AI is something that is still up for debate, but in the near future, it looks to be that way. So it would be fair to talk about the tariffs in relation to Amazon because they are an e-commerce business usually and first and foremostly. So it's a concerning point to touch on with this business. And Amazon's CEO has said that sellers will try to pass along tariff costs along to buyers. So the consumer will eventually actually fall foul of this. And this is something that I think is the problem with tariffs overall. In terms of Amazon's actual outlook on it, Andy Jassy, which is their CEO, actually brought out a shareholder letter where he discussed a little bit about tariffs and the impact on the business. He basically passed around that it wouldn't actually affect the business as much as you might think. Mainly due to the fact that the growing profitability this company is seeing is not mainly coming from the e-commerce side of the business. And we think of Amazon as this e-commerce giant, and it is, but it is also a tech-focused company with amazing industries in software that we don't really think about as being main sources of revenue for this business. So I'm going to show you guys why I think their operating margins are going to continue to stay slightly elevated, maybe not at these levels, but continuing to offer profitability and amazing returns for the business in terms of overall operating cash flow and cash. So here we have their operating margin, which sits at about over 10% right now. It's continued to elevate in the past, say, year and in the past, say, 2 years. And we've seen this before with Amazon with fluctuations, but never to this degree. And the main reason is because the revenue streams have dramatically changed against their average. So their operating margin of 6% doesn't really apply anymore. And to show this and sort of demonstrate a little bit, I would have liked to show this in a graph. But here we have a comparison between 2024's revenue streams for Amazon with a breakdown of business segments and their 2014 revenue breakdown. And we can give it as a percentage here. So right now in 2014, their online stores made up 77% of their overall revenue. And now they only account for about 38%. So in 10 years, we've almost halved that amount. So the profitability, the money, is coming from elsewhere. And if we look at their physical stores, that is now making up about 3%. It's a very small amount for this business. Their third-party seller services has dramatically increased and is a higher margin part of the business, operating better operating margins. So in 2014, they were sitting at 13.2%. Now they're currently sitting at 24% in this business segment. Advertisement services has over tripled or quadrupled in that time. So it's at 2.5% in 2014, and it now sits at 8.8%. Subscription services, again, has more than doubled in the space of about 10 years, 3.1% in 2014 and 7% in 2024. But the big one, the one that everyone pays attention to, notices, as part of revenue stream, AWS, their cloud service provider, used to be around about 4.8% of their overall revenue, around about 4.3 billion, and now it currently sits at 107 billion. So it's massively overperformed and grown quicker than overall revenues for this business in that time. And it now sits at 16.9% of all of Amazon's revenue in 2024. So whilst this business has grown massively in terms of amount of cash it's brought in from its revenues in 10 years, we're talking going from 88 billion to 638 billion. There is better segments that are becoming more and more part of Amazon's revenue. And these are higher margined and will lead to growing profitability. So now we get on to my favourite metric for Amazon, and the reason I think it's undervalued right now and could potentially have a margin expansion or at least a little bit of one, and is offering a good sort of growth rate compared to its price right now. And that is, of course, its price to operating cash flow. Now, I apologise in advance, I use this metric all the time. It's one of my favourites for Amazon. It's the best representative for its current value, in my opinion. Right now, it's sitting around 17 times. 17 times for an amazing business that's expected to grow at this number in operating cash flow in around about the 20 to 30% range in the next 3 years from analyst estimates. So that's a really good price for a company that's expected to grow in that way. And their average in the past has sat closer to about 26 times. So whilst it was growing quicker then, I'm not saying that, it's also a different business in profitability as we've just seen. So in my mind, this is offering a very good opportunity. Just to show what I mean by this outperformance and demonstrate what sort of fair value and overall buy price we should be looking at, I've got a 5-year time horizon with operating cash flow. If we say that their operating cash flow is going to grow a lot more conservatively than they're estimated to, they're estimated to over around, say, 20% for the next 3 years. But if we're doing a 5-year time horizon, we want to be conservative. Also want to allow for the tariff concerns that people have because they are relevant and they could impact the business, especially in this first coming earnings, because guidance may be lowered. So in that particular case, I would say we're looking at a metric growth rate of around about, say, 12%. 12% is incredibly conservative. It doesn't allow for much sort of leeway. They aren't really doing any dilution now, but we can still allow for it, so I will leave it in. And then we do a price ratio that I think is appropriate for this business. Currently it's sitting 17 times. So if we look at what that actually factors in, that doesn't really allow for much growth rate from here. We're looking at a fair sort of value around the market average. But if they're expecting to grow those operating cash flows by anything higher, say 15%, we're looking towards outperformance from this point. And that's not even allowing for a price ratio that I think's more appropriate. So if we allow for, say, a 13% growth rate, and we allow for around a 19 times price to operating cash flow, then we can still see overperformance from this point, around a 13% CAGR over the next 5 years, and a fair value of $222 per share. And I think that's sort of fair for Amazon, even with these tariff concerns. So I think it is one that could be set to outperform. The next one is one that maybe is not for everyone, and that is United Health Group. Now, United Health Group, whatever your thoughts or feelings about American healthcare, is beginning, especially right now, to offer great value, especially relative to their future potential growth. Now, the reason I say that is because this company, more recently, may be down around about 18% on the month and around 20% on the same day, which was one of the biggest drawdowns in their history of, say, 20 plus years. So that's the most it ever fell. And it's an amazing quality business that maybe, I think, is an overreaction to this earnings report. Yes, they lowered guidance, but we're going to touch upon that now. And their revenue growth is continuing to do very well. It's not shown a down quarter in around about, say, 7 or 8 years. So when I look at a business like this, with this sort of organic revenue growth and continued profitability, I question why the market is maybe punishing it the way it is doing with this business. Now, I'm not saying they don't deserve it because of their guidance, but we're going to be talking about that shortly. So what happened with their earnings report? Well, it was considerably a bad report for this business in pretty much every way. Now, one of the main things that I think people were concerned about and always are worried about is next earnings. What's the next earnings going to be like? What's the guidance for the year? If that is lowered, as it is in this case, the market always sells off the stock, and usually over 10%. In this particular case, the company is now expecting adjusted profit per share, so earnings per share, between $26 and $26.50. And that is compared to prior forecasts of around $29.50 and around $30 per share. Now, there is no really good way of putting it. That's bad. What I would say is that what they've expected and said is still positive. So they were saying that nobody expected this level of a miss or a cut from their guidance team. And they've said that United Health Group to serve more people more comprehensively, and it didn't really perform to expectations. And they're aggressively addressing the issues that were raised here, which is the increased medical costs affecting those margins and overall lowering their expectations for earnings per share growth. It wasn't something that was just linked to United Health. Obviously, it's had a big impact on lots of different businesses because Medicare costs even are sort of universal to those types of businesses. In this way, United Health Group suffered along with all the other big sort of Elevance and Cigna and CVS. They've all gone down as a result of these reports because they believe that will affect other businesses. But one thing I want to point out, and one thing that is still to be highlighted for this business, is its excellent quality, its continued shareholder sort of valuation and a reward for holding the stock because they continue to buy back their shares, they continue to expand their free cash flow and are offering good buybacks. This stock was a safe haven for many among tariff and policy uncertainty. And I think this is something that will do well and outperform from this point because as we start to see this tariff environment have a bit of an impact on earnings maybe, and you see certain companies like maybe Amazon sort of not underperform, but certainly get hit a lot harder because they're a growth stock, and we see like these heightened interest rates have an impact on growth stocks. I think stocks like this, which are more defensive, which are consistent and are always paid for by people, will do well. And I think this is where we're sort of seeing this company's been beaten down after its earnings report, but will slowly start to recover and maybe outperform the market. If we break this company down in terms of its EPS growth, we see a very positive trend that is something that shows its high quality. It's a consistent rewarder in EPS. Now, they did have a minus year. That was because of a one-time expense in March 2024. And that was because of the cyber attack. They had to pay a lot of money out for it, and it cost them quite a bit in terms of overall profitability. And this sort of drags down what we're actually seeing, which is that their earnings per share is consistently growing and still consistently growing despite them having revisions in guidance. And I think this is something that the market is overly pessimistic on and something that will help this company grow into the future. And we get on to the price of why I think this will outperform mainly is because the price relative to its earnings growth is looking undervalued to me. Their price to free cash flow sits around 15 times and their price to earnings sits around 17 times. On a forward basis, their price to earnings looks a lot better, below 15%. And they're expected to grow around about 15% from analyst reports in EPS for the next, say, 3 years. And I think that means that this valuation of price to earnings is very conservative. It's on the lower end of what I would expect for a business, and it's around about a 1 PEG ratio, which is something you don't really see for such a high quality business and name. This stock is being priced as though it is going to go out of business or that its revenue is pretty much flat. That's not the case. This is still growing very profitably, over 10%, and their price to earnings is continuing to increase as we saw with EPS. Just to show you guys how this business is starting to look really undervalued in comparison to maybe another business that is not growing as quickly. We've got United Health Group at a free cash flow yield of around 6.5%, 6.4% now. And we've got MO, which is Altria Group, a tobacco-based company that primarily focuses on dividend yield and paying out its cash flows as a form of dividend. And that is getting contributors around an 8.7% free cash flow yield right now. So if you buy either of these companies right now, you're getting those sorts of free cash flow yields. But the difference in these companies is in their revenue growth, their organic revenue growth, and their EPS numbers. So right now, we have United Health Group growing like this, over 10% each and every year. Meanwhile, we have Altria Group, which is revenues look pretty much flat, if not down for the year. It's not growing anymore, organically or otherwise, and therefore its EPS numbers and primary profitability is going to continue to decline with these sorts of numbers. But right now, you're getting a free cash flow yield in the form of United Health Group that is a lot higher than, say, I think it deserves. We're looking towards the future with this one, so I want to look towards their net earnings specifically, or their EPS growth. And I'm giving them a growth rate of around 13%, which is still on the minimal to conservative side. It says that they're supposed to grow analyst growth rates of around 15% to 16% in the next, say, 3 years. I think that is on the more, maybe more aggressive side than I would maybe prefer to value this company. But if we give a 13% growth rate, which I think is about the medium of what I would put, we allow for no buying back of shares. They do it consistently, but I want to allow for just nothing like that for now. Dividend growth rate, say they lower the dividend growth rate to around 5%. Then they only still then offer a fair value of $556 per share and a CAGR of about 16% from this point onwards. And these estimates are sort of on the medium side. We could maybe adjust this up, say that they only grow around 11%, and we say that their price ratio stays where it is at the moment, say around 17 times. At that point, they're still managing to outperform the market at a 12% rate of return and a fair value of $460 per share. So when I look at this business, even on massively conservative estimates, we look to outperform. Now, if we look to maybe see more aggressively around, say, the 14% mark, we say that their price ratio goes back up to around 20 times and they buy back around about 1% of their shares per year because they believe they're undervalued. And they also allow for a dividend growth rate of around 10%. Then we get a fair value CAGR around 17% over the next, say, 5 years and a fair value of $584 per share. And still, I think this is allowing for a good amount of a margin of safety with these estimates. So in my mind, I think this business is one to watch, in particular in 2025, because as people look towards the future and guidance is revised for this business and is already lowered, expectations are incredibly low for this business now. But big investors, maybe people that want to invest in this area, I think could look to add this one into their portfolios because it's so high quality, and the share buybacks they do, the dividend growth rate they do is very appealing and is offering good predictability into the future despite their more recent revisions in revenue and EPS guidance. So I actually really like this one, and it's one I'm actively considering for the portfolio at these levels. Now the final stock, the one that I think's one to watch in 2025, is Uber Technologies. Now, Uber's one that has fluctuated. It's up 12% in the past year. In the past month or so, it's still outperformed the market, up by about 4%. And it's actually one that I think is offering really good free cash flow yield right now, great prospects for growth, and is still limited for some reason by the market because I think they're concerned about Tesla stealing market share and self-driving cars and stuff like that. And I just don't think they're really founded in fact. I think that they're the main aggregator and they will do well in the sort of risk-averse sort of world that we live in. And if we look at their revenue at the moment, they've grown it massively. And I think this is something that if you're looking at this chart, you're not looking at a dying business. You're not looking at a business that is getting pushed out of market share in areas. You're looking at a business that is growing rapidly. 3% CAGR is around 27% to around 12 billion in revenue in 2024 in December. And their free cash flow looks exceptionally good as well. We've got free cash flow now of about 6.9 billion in December 2024. And this is grown from massive sort of levels in 2019 of expenditure and sort of minus free cash flow growth. So when we see something like this shift to massive growing profitability, this is something where we expect a stock to do very well. And Uber is one that we expect to do well because of their guidance that they've offered. And just to show really how well this stock could do, we're going to use their guidance and sort of use that in our valuation model and look at their free cash flow growth rate as well. So when we demonstrate strong progress against their 3-year outlook, their gross bookings has grown in 21% year over year in 2024, and their 3-year outlook is they expect mid to high teens CAGR for this. So that is a growing business. That's not a declining business, in my opinion. If they've got gross bookings that are continuing to grow well over, say, the 10% range, we're easily talking about a company that's maintaining its market share, in my opinion. And their adjusted EBITDA growth, which is the main primary metric that they use, which I don't like as much, but it does offer a good opportunity to see how profitable this business is going to grow because they've given us a free cash flow number as well. They grew at 60% year over year, and they're expecting high 30s to 40% CAGR for the next 3 years, which is just amazing levels of growth. Now, when we look at this EBITDA to percentage to free cash flow that they expect 90+%. So when we're talking about 30 to 40% CAGR growth for the next 3 years in EBITDA, and a 90% conversion rate to free cash flow, that is exceptionally high growth rates for free cash flow. And just to sort of show what they're offering, and we're going to be using that in our valuation model shortly. Using that valuation, those growth rates that we were seeing here, I've tried to give a fairer growth rate based off the guidance that they're giving rather than the overall perception of their growth rates and how they will decline. So in their free cash flow for the next 5 years, I said a growth rate of 25%. That's still arguably conservative and arguably aggressive depending on your outlook for this business. And their shares outstanding, I would say, sit around about minus 2%. I'm still allowing for a slight dilution of shares their new CEO has stopped this sort of continued share dilution of shareholders, but they still have a bit of stock-based compensation. So I want to allow a little bit for that into the future. And their price ratio, I've given a price to free cash flow of 20 times. At the moment, they don't trade at that. That would be a margin expansion. So it is worth considering whether that's going to happen. And they then sit at a massive outperformance. Their fair value sits at around about $113 per share if we look at this valuation, and a CAGR about 18% over the next 5 years. Now, I would adjust this up basically for my own sort of sensibility to sort of allow for a bit more of a realistic growth rate. I think the price ratio here is fair at 20 times, but I would allow for a 20% growth rate in free cash flow. Say they have a down year or a year that doesn't go that well, I want to allow for that in my estimates. And their fair value still looks at outperformance at a fair value of $92 per share and a CAGR of about 13% from this point. So I would say Uber's definitely one to watch, especially at this current valuation, and I think it would offer a good return right now. But that's just me, guys. Those are my picks. United Health Group, Uber, and of course Amazon, all of which are things that we will want to consider for the future. But what do you guys think? Do you like these stocks? Do you looking to buy any of these ones? Let me know down below. And as always, thanks for watching, and I'll catch you in the next one.